Okay, welcome everybody.
That's still not the right view.
Okay. Thank you. All right, everybody. We'd like to welcome you to Fluent Financial's first webinar for January 2021. 2020 was an interesting year that none of us will forget, and there was a lot of bad things that happened. There were some good things, and suffice it to say, I think 2021 will be a much better year. Joining me on the call today, I have Mike Lanise, our portfolio manager, and Tabitha Garafa, who's our director of operations and also a financial advisor. And today in our call, we're going to talk a little bit about the 1099s, the COVID vaccines, a little bit on COVID. There's some really good news there, and some of the economic data, which in generally we're looking at a situation where markets and the economy is going to be recovering. So I think 2021 will make up for a lot of the darkness of 2020. So I'm going to go ahead and turn this over to Tab, and she's going to talk a little bit about the weekly videos that Mike does.
So every week, me and Mike work on a video, and it's just a short video, and we post this on our webpage under the press section, and we also put it on our LinkedIn pages, but where he talks about what happened in the market last week and kind of what we see forecasted for the week to come. We also give a little summary about what's going on with our portfolios at that time and how much call income we've generated from those portfolios. We post these also on YouTube. And we do have that subscribe button in the bottom right-hand corner that if you do subscribe to our YouTube channel, once we post these videos or anything like the webinars we're doing today, you will get that notification that we've posted new content for you to view.
Fantastic. 1099s are always a big question we get at this time of the year.
So the 1099s, TD has started sending those out, and you'll start to get notifications when your 1099 has went out. When you get that notification, just know that it'll probably be about 5 to 7 business days before that will arrive in the mail. Even if your statements are coming to you electronically, everybody will get a paper copy of their 1099. The 1099s for the retirement accounts will come out for anybody who took IRA distributions, and those typically are the first ones to come out. But for those with their investment accounts and their non-qualified accounts, the 1099 consolidated, those typically take a little bit longer to come out, and they will have corrections to them. So we put these dates up here so you can kind of see what to anticipate. And we do say that do not file your taxes at least until March. Even though you have your tax documents, there may be corrections to those forms that, just to be on the safe side, you should wait until March. And then two, just as a reminder, anybody who is on the line, please mute your phones so that we don't have that background noise coming in.
Yeah, and one thing, I've been doing this for 25 years. I don't think there's been a 1099 that wasn't amended because it seems like a lot of the ETFs always seem to have restatements. So again, wait to the end of March. Don't file too quickly.
And I also did confirm with Orion today that TD has sent those, and they're starting to trickle into the client portals. So it's under your documents, you'll see your statements, and then you'll see tax forms. So just anticipate those will be coming, but it takes about a week after TD has posted them for them to make it into the client portal.
Okay. Next thing we want to talk about is the vaccine availability, and this is just strictly for the people that live in Dallas County, which is the majority of our client base. Every state and county is going to have a little bit different rules about who can get a vaccine, but Texas is leading the nation in terms of people who have gotten vaccines, but there has been a few problems.
Yeah, Tarrant County has been doing a little bit better job of getting people that are in the 1B group vaccinated, but right now Dallas County is really struggling with this, where they seem to be stuck in that 1A, and they're kind of going back and forth on who is qualifying under that 1B. They've been trying to do some that were over 75, so they're not kind of sticking to what those federal guidelines were that they're putting out, and there's just not enough vaccines at this point. So we do encourage everybody, we put that website down at the bottom of the screen, to visit that website to sign up if you are wanting to get that vaccine. But in Dallas County, there is about a 300,000 wait list right now.
Yeah, thanks, Tab. This is Martin Luther King week, and he got the Nobel Peace Prize in '64, and he had a very famous line that he said. He had a lot of good quotes. I believe that unharmed truth and unconditional love will have the final word in reality. This is why right, temporarily defeated, is stronger than evil triumph. And I think these words hold very, very true today. And let's hope with this new administration that there is unity and not divisiveness going forward for our country. Now we're going to get into some information on the economics front. And again, these quarterly reports are a little bit longer than our normally monthly webinars because we go into a little more detail. ITR is a company that I've subscribed to for years, Alan Brian Bullilu, and they talk about some economic conditions. They have a very high accuracy rate of predicting business cycles. And when you look at these charts, and there's about 4 or 5 of them we're going to go through today, you've got these phase keys. Blue represents a recovery. Green, I should say. Phase B is accelerating growth. Phase C is slowing growth, orange, and then D is a recession. And and these column headings are what are the conditions of these various sectors as of the end of the calendar year. So this is 12/20. The U.S. core economy at a glance, almost everything was in a recession, the exception being U.S. defense, non-capital goods orders, and then retail sales. All the other areas are still struggling coming out of the COVID pandemic. 2021 should be a very strong year for all sectors, 22 slowing and 23 picking back up again. Then if we look at the manufacturing sector, you see a similar pattern. I think the big difference is that North America light vehicle production is starting a recovery phase. With all the cheap money that's out there, people not able to travel and spend money in hospitality, they're buying cars and trucks. Used cars have quite a bit of value. Machine orders are starting to pick back up, and most of these sectors are going to be in a solid accelerating growth. And then 22 and 23, we expect to see more growth in all these sectors. Then if we look at the construction industry, again, low interest rates really drives construction in the real estate market. A lot of people refinance houses. Companies have issued a lot of debt because the money is almost free. Single housing is just taken off like a rocket ship. A good buddy of mine lives up in Prosper, which is a little bit north of the Dallas-Fort Worth Metroplex. One of their builders up there is only selling 2 houses a week to people who want to buy them because they have like 10 people who want to buy a house, and they're limiting the number of houses that are available because it's just white hot. And a lot of other parts of the country are experiencing this as well. A lot of it may be a permanent rotation where a lot of the people may not go back to the offices. We've seen numbers of 20 to 25%. But again, you're seeing some green shoots here, private warehouse construction. Think of your Amazon fulfillment centers, Capel, where we live. We have 4 of them. Obviously, the Amazon had a fabulous year last year in a lot of the warehouse area. Multifamily tenant, commercial office construction is going to be hurting a little bit more, but it's kind of a similar pattern to the other. If we look at the global economy, the United States weathered this storm pretty well compared to most of our trade partners. China probably did a little bit better job. Again, a lot of people say you can't trust the numbers in China, but they did a really good job. The Europeans in South America and Africa did not do as well as the United States did. The Europeans adopted more of a shutdown measure, and it's been proven that shutdowns really do not reduce the COVID virus significantly, but it destroys economies. So that's a huge problem. So our country overall was able to keep most of its cities and states open, and that's served us well. India is really interesting. I talked a month or 2 ago about ivermectin being a very powerful drug that really helped India turn the corner because they don't have the big medical facilities we have, and you can see what's happened to their economy. So they're doing really well. So the global economy overseas is going to take a little longer to improve. We're a little light international in our portfolios because we just don't feel like it's safe to really make a big allocation to that sector. If you want to take high risk, you can invest in that sector. And speaking of the financial area, the U.S. economy at a glance, the stock market, stock prices, ITR is always very hesitant to predict where the stock market is going. 75% of the time, the market does go up. But I think the important point here is that they're emphasizing it's more of momentum than foundational value. It's what's driving the markets. The other thing you'll see is that the bond market, which has barely been dead in terms of any kind of interest rates, and the bond price is all-time record high, so it's in a recession. And these are the expected long-term yields, and we're looking at very, very low interest rates on bonds. I mean, this is incredibly low rates. And the problem when you have very low interest rates on bonds, as soon as interest rates go up a little, the bond prices normally drop pretty significantly. And for the oil sector down here, the second from the bottom, these are anticipated prices of crude. We're already over $50 a barrel right now. And I think we've not even had significant demand pickup. So I think it's anticipation, and it's going to take a little bit of time for the supply to kick on. And Biden, one of his first things that he signed was killing off the Keystone Pipeline. So that's going to restrict supply in this country. So again, some of the more green focused policies of the Biden administration are coming to light. A lot of people are saying, Mitch, is the market overvalued? And I think this is a really interesting chart here. It goes back about 25 years. And you look at the S&P price earnings index. And if you look at it today, we are at 22.3, which is high because you're normally looking at about a 16 as the long-term average. And if you look back to 2000, before we had the big dot-com crash in March of 2000, it was 27.2. But here's the significant difference. Look at the 10-year Treasury. It was 6.2 back then. It's 0.9 now. And when you have a very low interest rate, the market can handle a much higher PE ratio without it being overvalued. And this next chart basically conveys that message. This is from Bloomberg. And you look at the PE ratio a year ago, it was actually about 30. Now it's around 25. This line kind of represents kind of a fair value for the market based on the 10-year Treasury. So the market is not significantly overvalued today. The other challenge we have is where are you going to put money to get any kind of rate of return? Bond market's not going to do very much. Real estate's illiquid. Gold doesn't pay a dividend. If you have a bunch of it, you got to pay storage. You're getting pushed in the equity market whether you want to or not. And it creates a lot of consternation for people who are looking for income. And Mike will talk about our stock income at the end of our webinar, but that's our solution in using options to generate income, because bonds historically 15, 20 years ago were a great avenue to generate income or create a retirement paycheck. It's not true today. So we look at the surveys of what the banks are saying. What is the S&P 500 going to do for 2021? The consensus is 7.7. Pretty big discrepancy. Bank of America down here at about 1.7%, and JP Morgan up here at 17. I think the bottom line is no one really knows. I think it's just safe to say that there's a 75% chance the market will go up. A lot of people say, well, Mitch, what's going to happen with the election with the Democrats controlling the presidency, the Senate, and the House? So if you look at a 120-year period, the Dow Jones goes up about 17, 18%, annualized about 7.8. It's up 65% of the time. Really, there's only one time, and when you had a Republican president, Democrat Senate, and a Republican House where the market went down. Again, the markets have a tendency to go up. So I wouldn't be too worried or concerned that the Democrats control all of Congress. They have very, very thin margins. Joe Manchin, and I think it's Angus King out of Maine, are very conservative Democrats, and they have not endorsed some of the more radical elements of the left wing of the Democratic Party. So I think you're going to see probably more reasonable legislation coming out of D.C. We don't need to leave the country today. Our country's not going down the tubes. Just kind of wait and see what happens. But a lot of people who support the Democratic Party are big business, big tech, and a lot of their compensation comes from stock price appreciation. They're not going to want to tank the market because it hurts their own money. So I don't expect that from happening. And just speaking of the market, I said the market's up about 3/4 of the time. You can see this for over the 41 years. It's been up 31. The red dots represent the low water mark for that year. The bars represent what the market did as of 12/31 at the end of the year. Last year we were down 34%, hit the low on March 23rd. We finished up 16. Mike's going to talk a little bit more about kind of, it's such a narrow market. We only have a very few number of stocks that are supporting the market up, and it's not a broad recovery. We're starting to see a turn into more value industrials and energy stocks. I know it was kind of a tough year for a lot of people that were in our V&O portfolio as well as ADVP, but your patience has paid off, and Mike can talk more about that. I think a real critical part of our economy is what drives our economy, and the answer is people on this call. 68% of our economy is driven by what we spend as consumers. Only 18% is government, 13% is investment housing. Exports have a tendency to be negatives. We import more than we export. The dollar is going to get weaker, so we expect this deficit to grow. This is, the trend growth line. We're expecting to be about 2.5% long term. Here's the dip, and here's kind of this V-shaped recovery. We're still recovering this year. We may be up at 5% for the year, which would be a record year, but we're still in a recovery mode. The hospitality sector has been hit the hardest, and we've shared this chart on and off over the past year. There really has not been a lot of significant changes. Airlines kind of picked up over the holidays. I think people are feeling a little more safer to fly. Seated diners probably from November into December kind of decreased because some of the states on the West Coast and the Northeast started invoking shutdown measures, which those of us in Texas are grateful we're here. We don't have to go through that. And then mortgage refinancing and people getting mortgages is at all-time high levels. Retail spending hasn't dropped off significantly. What you're going to see happen is as the vaccines get administered, there's also a lot of herd immunity that's going to occur. We feel like by the second quarter, we'll definitely be on the backside of this, and possibly it will happen sooner. AstraZeneca and Johnson & Johnson's vaccines are not yet out. It's just Moderna and Pfizer's. But when they come out, I think the issue is going to be in second and third quarter. Is everybody going to be required to have a vaccine? I think that's going to be one of the big issues later this year. If you look at a global level, the United States and our net worth, we're at a record high of 128 trillion. So if you look at our debt, say 27, 28 trillion, it's more manageable. I think what's really interesting on this chart is this part here, this graph. This was started being measured in 1980, and this is household debt service ratio. I think a lot of Americans, and granted, a lot of Americans who have resources are older or in retirement, and people that are younger who see the damages of debt have really taken notice. So you see this debt number decrease quite a bit. Plus low interest rates, people have been able to refinance their debt. The downside is this part here, that student debt continues to be a huge problem for the millennial generation. I can't think of very many businesses that can increase their prices 7% per year for the last 20 plus years and get away with it. But our college universities are happy to do so. And some of the degree programs they're offering that are really, they sound really interesting, but the kids end up being a barista at Starbucks. And if you look at kind of the debt situation here on this next slide, government debt is this dark line. It just goes up like a rocket ship. Our government was spending money to keep our economy from collapsing. Corporations are taking advantage of low interest rates, so they've issued more debt. But look at us as consumers. We've paid down our debt. So you could say we're the responsible party of the three. Something else here, and this is a potential problem down the road. You look at duration, and duration it basically says when is the debt going to be paid down, and the longer the duration, there's a greater sensitivity to interest rate movement. So as this has spiked up, when interest rates start to go up, and we think we'll see them go up in 23, people that hold lots of bonds now are going to see hits to their principal and bonds. For the next couple, 3 years, you're probably going to be okay. And those of you who've had bonds for a long period of time with high coupons, hang on to them until they get called or mature, because you can't replace them with anything close to what you're currently getting paid. And then if we look at the federal government, and their household finances. You can see this big spike that we had here after the housing crisis, and here's the COVID crisis and the ton of money our government spent. So we're about 100% at a net debt basis of GDP. There's charts that I show with Japan in some of our meetings. And just to put this in context, Japan's at 260, and they're the third largest economy. They've been there for a couple of decades, and their economy hasn't collapsed. So I'm thinking that our people in Washington at the Federal Reserve probably look at Japan and think, we have a birth rate of 2.0. We have a more of a pro-immigration policy, even more so now. We can afford a lot more debt. And I think the critical decade is going to be the 30s, as the baby boomers all of them basically are in retirement. And as the baby boomers pass, is there going to be enough millennials and Xers and Yers to support the system? I think our government's just going to print money to keep it going versus having some significant contraction, recession, or depression in the 30s. But even why this is alarming to some, I'm not as concerned about this because what I've seen what's happened in Japan, so there's been a precedent set. And if you look at wages and unemployment, again, this is kind of a 20 was a rocket ship down, rocket ship up, about 15% unemployment. Now we're down about 6, 7. Wage growth kind of spiked up because no one wanted to work, so you found somebody, you had to pay quite a bit for them. Now that's coming back down to about 4%, which has been the long-term average in terms of annual increases. One thing that's not showing up on this chart, we have about 3 million Americans who are not showing up. They just quit looking for work. I think as the economy comes back, those people will enter the workforce, but they're not showing up here. So the actual unemployment rate is probably closer to probably 9 or 10%. Inflation, a lot of people are worried about all this money that's being printed, all the money that's being spent. Are we going to have some inflation? And what's been a kind of a conundrum for a lot of economists is why aren't we having a significant inflation? And I've not really heard a good answer for that. The personal consumption expenditure factors at 1.4, and the Federal Reserve, for years has kind of targeted 2% as the amount that they look at is when inflation's getting out of control. They've actually increased that, and I'll share that new number with you in a second. And we're talking about the Fed. This is their projection of what they expect interest rates are going to be on the Fed funds rate, and it's basically hugging the floor. And this is into 2023. They got 2.5 up here. This is starting to look like a moonshot. Again, but inflation, and you look out here, there's just no significant inflation. So it allows people to pay down their debts. If you have low interest on your debt, you can carry more. Mark Cuban had a quote I heard on the radio a couple of weeks ago. He said when people buy a house or car, they're more interested in what the monthly payment is than what is the total amount of the debt. And those of you that are fiscally astute, which is everybody on this call, that's not the great way to look at it. But for a lot of Americans, that's the way to look at it. And I'm starting to think our government is as well. So I talked a second ago about the Federal Reserve and some of the changes in their philosophy about tightening money, raising interest rates. And they historically have had this 2% target for 10 plus years. Now they're looking at a 2.38% level for 3 years before they'll start tightening, which means increasing the interest rates. And when they start doing that, it has a negative impact on bonds. If you look at what happened here in 2013, the bonds really got hit hard in June when Bernanke said they were going to start raising rates. And again, we had that again happen in 18 a little bit. So, and when the rates are incredibly low, that shock is much stronger. So those of you that are holding bonds, just be very careful. If you've had them for a number of years, consider yourself fortunate. You had nice price appreciation and you're still clipping a decent coupon. So now I would like to turn to the oil and gas market. And what we have here is, and we share this periodically, you look at the inventory, which is the dark line, and then the rig count, which is the blue line here. And we've been drawing down inventories. It's starting to pick back up. You're seeing the rigs start to come back online. Oil, it's now $51, $52 a barrel right now. And $40 is kind of a break even for our frackers to make money. I know Saudi Arabia announced in the last week or so they're going to reduce output by $1 million per barrel or per day in February and in March. So that's going to help this economy recover. Mike will talk more about the energy sector and the direct impact to our portfolios. And the last slide I'll talk about here on the economic front is the heat map. And it basically talks about, how is the world overall economic activity. Red represents recession. This is the housing crisis here in 08 and 09. This is the European recession that we missed. And obviously this is the pandemic that we're getting out of. Not all the data is you have gray boxes here. What's interesting is look at the US. We're doing phenomenally well compared to the rest of the world. We're having pretty solid growth and not everything's open yet. So whether you were a fan of the previous administration or not, I think they made a wise decision trying to keep the economy going without it crashing. If you look at the European area, they're really hurting. And they just were more interested in a lockdown. China, and I've got to be careful what I say about China. They have a lot of responsibility for what happened. Their economy was not hit as hard. India, because of them using ivermectin and being, I think, very proactive in trying to find solutions that work. I think their economies come back nicely. Brazil's doing pretty good. So we're going to see a pretty quick recovery in our country. Europe is going to lag a little bit. So now, and again, we're going to answer questions at the end of this. If any of you have questions about anything I covered, I know I'll go through this quickly. Please ask them and we'll go through them at the end. Now I'm going to turn this over to Mike.
Thank you, Mitch, and thanks everyone for joining us today. This first chart, I keep using February 19th of 2020 as the high before we started shutting things down, before the virus really started hitting us. So this just gives a quick view of what has happened over these last 11 months. This goes through January 15th of this year. And you see the S&P is up 11.28% from that previous high mark. And then something to point out is the purple line. The purple line is your NASDAQ 100. And the NASDAQ 100, 40% of that consists of your top 5 FANG stocks, or it's very tech heavy. I don't think Amazon is in there, but you have your S&P is about 28% of your top 5 companies, whereas the NASDAQ is almost 40% of them. If you look at the little red line that you see kind of embedded in this chart, the green line is the Dow Industrials. That red line is an equal weighted S&P chart. So if you were to give every company 1/500th of the slice of pie, that's what an equal weighted recovery is happening. And you can see that it's caught up with the Dow. With the S&P right now. And that's important because when we talk about a recovery and what's occurred, we've talked about it in the past. It's been a recovery of the haves and the have-nots, where the FANG and stay-at-home technology stocks take off, where things like industrials and oils and bank and financial sectors have just been killed. Mitch, you want to go to the next slide, please? All right, so let's break this down a little bit. This is what happened since November in each of the different sectors. So we kept saying, look, we're gonna have this recovery. It's going to be a broader market recovery. And if you look at this, the bright green line that seems to be pulling away from everybody is the energy sector, up over 47%. And then if you look at where the S&P is embedded in here in a little white line at 7.3%. These technology stocks are just below that. It's a light green line that you see there. And then your yellow line that's up there a little bit higher, that's your financial sectors. So what you're starting to see is this rotation out of your higher tech stocks into the stocks that weren't getting any of the love in 2020. Mitch, can we go to the next slide? Okay, so this is something else that's similar to that. What I wanted to show you is the breakdown of the top 5 largest stocks, your FANG type stocks. I removed Netflix from there because Netflix is like number 17 as far as the size of the company. It just sounds good when you say FANG, but it's Microsoft really should be in there instead of Netflix. So that's why you see here Apple, Microsoft, Amazon, Google, which is Alphabet, and Facebook. And you see the blue line is Amazon pulling away from everybody, up 64%, even with a pullback going into the October 30th. And if you look down below, the white line down below is your S&P. And it was positive being pulled up by these 5 names. But if you look at your Dow, and then the red line, the green line is your Dow, and the red line is your equal weighted. Remember I said 1/500th of the pie to every company. That's really what the markets were doing. So when people say, wow, market's recovering. No, it's not. Market wasn't recovering. Just the FANG stocks were having a really great run. That's where you see here the S&P, the 5 largest names returned 38.6%, while everyone else was down almost 5%. So if you go to the next slide, excuse me, Mitch. All right, so what happened between November 6th and now is, so November 6th was a Friday. That Monday, November 9th, before the market opened, I believe it was Moderna and Pfizer announced, no, it wasn't Moderna.
Just Pfizer.
Pfizer announced their vaccine was coming. And this is what the markets did. So if you look at these light blue lines here that are tracing at the bottom, these are your FANG stocks. And every one of them is below zero between now and this past, between that announcement and this past Friday. That's a rotation out of them. Doesn't mean those companies are awful. Doesn't mean they've lost their mojo. It just means that now money managers are people are starting to move in to a more broad-based rally. And that red line that's leading the charge up there, that's your equal weighted S&P, meaning everybody, 1/500th of every company is starting to feel that love, starting to benefit from that bounce back. Our stock portfolio had a really rough 2020 because we were sitting and waiting. We had a lot of energy, we had a lot of industrials, and our portfolio returned over 17% during this time period that you're seeing here. So we are above every line on this chart just because we were sitting and waiting. Can you go to the next chart for me, Mitch?
Yeah, this is a good Pfizer announcement vaccine. Why don't you talk a little bit about their timing of their announcement, Mike?
Yeah, okay. So if you guys recall, so November 6th was a Friday. We had an election that week on that Tuesday. And Pfizer made that announcement Monday morning, November 9th. And, Mitch came in the next morning and said, hey, did you hear, Pfizer knew about this a week or so before. They didn't want to announce it before the election. And I said, okay, I mean, you could look at that as something Pfizer's doing politically, but the benefit of a vaccine being announced is that the markets will probably start recovering even faster than they were already recovering before. And that would help an incumbent president at the time, Donald Trump. Why did they hold off? Well, Donald Trump pushes a lot of regulations not regulation, but he wants a lot of transparency for these drug prices and things in the healthcare sector. He says he wants the people to know what's going on. And if you are Pfizer's CEO, you have a responsibility to your shareholders. Well, if there's a sitting president that's going to hurt your shareholders and your profit margin versus the possibility of a different president coming in and helping your profit margin, or maybe not hurting it as much, your job as the CEO is protect your shareholders. So the fact that the Pfizer people decided to hold off on that announcement, I don't personally think it's I think it's a necessary thing as if you run a company that you need to do that. But that being said, unless you want to add anything to that, Mitch.
No, I think what it is, and I don't think it's a Republican Democrat issue. I don't want to get into politics on this call, but I almost feel like big money and big corporations and the politicians are more enslaved to them than they are their constituents. And hopefully this trend does not continue, because we all will be in bad shape in the long term if this trend continues. The censorship by big tech that was exhibited this fall and even now, it sets a very dangerous precedent in a lot of ways, we need a Teddy Roosevelt type president to break up big tech just to create some transparency so everyone can benefit, not a few select few. And the next slide, and this is the last slide Mike will talk about, and this is a little bit easier to read. The Bloomberg terminal has a black background. It's like the old Hasbright terminals that we had as kids, for those of us that are 50 or older. This is how our portfolios have actually done since the end of October, our stock-heavy portfolios.
And something that I'd like to point out on this, so we are trying to get back more in line with what the S&P is. The philosophy is, take a look at the S&P 500, pick some names that aren't dragging you down. Take the top 2 or 3 names in a sector and go with those and eliminate the ones that are dragging you down. And then you theoretically outperform the S&P. Well, we noticed value occurring in the oil sector as oil prices started dropping, as oil stocks started dropping. So we started getting heavy and heavy and heavy in them. And then we were in them waiting for the recovery. And so if you are a long-term investor, that's fine. You're getting paid a dividend, you're getting paid to wait. But it's scary when you have that volatility in your portfolios, if you're close to retirement or retiring. And what you're seeing now is that rotation back out, and you're seeing that outperformance. Now, as energy prices continue to climb, our theory is that there's tons of pent-up demand. And as of June 1st, if not sooner for spring break, June 1st, when the summer travel season starts, a lot of that pent-up demand will be released and your oil demand will come back. We are seeing energy prices go higher on the anticipation of demand. So that, people say, well, Mike, why didn't you get out of energy and then get back in when it was more secure? Well, this happens so quickly in these markets. We're still waiting on our event, which is demand to come back. And look at what kind of run the portfolios have made. If we were out of them, if we were on the sidelines watching this, we'd be done. The idea is to sell once all that demand comes back and those prices have recovered. Right now, this is just all anticipation.
And
so again, thank you guys for being patient with us, but this is why we're not popping in and out. We're looking at 1 year, 18-month, 2-year type investment strategies.
Yeah, and I think another point, and we covered this in our webinar last month, we did have losses in 5 of our oil stocks, and we made the decision to sell those stocks in December for tax loss harvesting purposes. And what tax loss harvesting does, you sell 5 oil stocks and then you buy 5 oil stocks to replace them at the same time. So you're not abdicating the sector, so you can continue to participate in the rally. So we sold our 5 oil stocks, bought 2, and then bought 3 of the stocks proceeds. We bought the XLE, the energy ETF, and we'll rotate back into the majority of those other stocks here around the 1st of February. So Mike, I appreciate the update. Next thing I'm going to talk about is COVID. I got some really good information to share here. It's really some good news, and I'm hoping with the new administration, mainstream media, or some people now call it state TV, will start reporting on this. If you look at the 7-day average test, we're still up here testing at a high level, but look at the positivity rate. It's falling. Confirmed cases is falling. 7-day average is falling over. The deaths are going to be a lagging indicator. They have been increasing. It's just horrific. 4,000 people dying per day. It just breaks my heart. But that's starting to roll over. Hospitalizations are rolling over. So all this is good signs. And this is a chart that just came in today, just literally about an hour ago. And hospitalizations have peaked and are falling. And what's interesting is if you look at this hospitalization, when COVID first got here, we didn't know what we didn't know. Then it got warmer out. People started going outside. Then we had a decline. We didn't necessarily have really good medical protocol, but being inside in dry environments is bad. Then in the South, as it got hot in the summer, the Sun Belt states, Texas, Florida, everything in the South, we had this big spike in the South. Then it decreased again. And then as it got colder, we had this huge increase we've had in the fall. And then if you look at it by region, if you remember the Midwest, they had this big spike here right around Thanksgiving. And I talked about this last month or the month before, where those cases are coming down. Okay, now we're starting to see that in the West, the Midwest, and the South. So there's a pattern here. Now, the other thing that's going to help with this is the vaccines, but a lot of medical people are saying there is a lot of Americans who've gotten this disease who now have, the nature vaccine and have that herd immunity aspect. And there's a report that I saw that said by March 15th, and I think this is a bit aggressive, they think between the herd immunity and the amount of people are getting vaccines, and again, they're assuming AstraZeneca, Johnson & Johnson, and probably others, that we're going to be vaccinating so many people, plus it's getting warmer out, that we're really going to be at the tail end of this. And I've said this in the past, those of you who put off trips and vacations for 2020, book them now, because by the time this happens, everything's going to be sold out. So do that. There's a group that we talked about last month, and the Frontline COVID Care Alliance, and then the Eastern Virginia Medical School. They are related. And this is a real interesting chart, and there's some data on it that's disturbing and also very good. I'll start with the disturbing data first. We've talked about hydroxychloroquine and a number of tests and examples. We've seen it be beneficial. In this table that just came out at the end of the year, unclear benefit and 10 the harm. Now, there were 20 papers that backed up this. I actually looked at them, and 15 of the 20, I didn't look at all 20, none of them had zinc. And hydroxychloroquine would only work well when given with zinc and erythromycin if given early. And these papers didn't cover it. A lot of these papers that they're going by were done in the spring before what was known. It is known that if you're in the hospital, you're on your last leg, it does not help, it does more harm. But that's the end of hydroxychloroquine. And there's a lot of other studies, and some of you are aware of them, but I think the important part is this one right here, ivermectin. I talked about India before. It is shown to be beneficial as a prophylaxis when you're symptomatic and if you're in really, really bad shape. It's widely available. It's been around since 1975. Hardly any side effects whatsoever. And what's interesting is some of the doctors, the Frontline COVID Care Group, there was Perry Corey, who talked before the Senate last month, and he basically was very firm with the senators saying, guys, we've got this eye mask protocol that works well. And his group, Frontline COVID Care Alliance, very respected doctors. Dr. Merrick, who's part of this EVMS, who's part of that same alliance, they're kind of rebels. And a lot of the doctors are very conservative. They're going to listen to their physicians group. They're going to listen to their hospitals. They're going to see all kinds of clinical trials. If they make a diagnosis and if they do something or recommend something wrong, they could lose their license. So they have a lot more to lose. So it's a lot easier for me to say as a financial advisor to talk about this stuff because I won't lose my medical license. So to the doctor's credit, but what these doctors were saying is that 90% of the medical profession doesn't even know about this. So those of you on the call arguably know more about COVID therapeutic treatments than your doctor does, which is a sad commentary. But here's the good news. So he talked before the Senate in December, and guess what happened last Friday? The NIH now is allowing ivermectin to be used as a therapeutic option. And here's Paul Merrick and then Perry Corey, the founding members of this Frontline COVID Critical Care Alliance. So the NIH finally is endorsing a therapeutic treatment that is effective, that's inexpensive, that will get hospitalizations down. So I don't know about the people on this call, but I probably know of 3 to 5 people every day I hear of that have COVID. I had 3 clients in here yesterday. All of them have had COVID, and they didn't have a bad outcome, obviously, and minor symptoms. And I think everybody on this call knows somebody. But those of you who have loved ones or are family members in rural areas that don't get good information, this site, and they have the treatment protocols. We shared it in our webinar last month. Just go to their site. Again, we're not medical professionals. We don't pretend to be, but this is just information. My brother, who's a PhD doctor, works in the medical area, he's just furious about the malpractice that's going on in this country by our medical people. And what's interesting is on that chart I shared with you on the prior page, It was a 49-page report. Then you got all kinds of endnotes. And this is something I was doing the research. And they were talking about why has this happened. And it goes, how does the NIH arrive at the recommendations for currently widely used therapies? Why is this rationale for these recommendations so difficult to understand? Their answer is we're unable to identify a constant approach to the strength and timing of the NIH recommendations and or the updates to the recommendations. However, the influence of big pharma appears undeniable. Now, these guys are more rebel doctors, and I've shared this in the past with you guys. When you go to the NIH panel and you look at financial compensation by people who work for them, you see Gilead Sciences all over the place. And guess what drug Gilead Sciences make? Remdesivir. And that's what NIH was pushing. And when you looked at the prior chart, remdesivir had a nominal impact. So, you know, the bottom line is we're getting towards the end of this COVID. We still got a ways to go. Still take precautions. Wash your hands. Don't go to crowded places. Wear a mask. But a lot of people I know have been kept up in their homes. You miss seeing your loved ones and your friends. You miss going out on trips. You worked hard for your whole career. You feel like you're in house arrest. It is going to get better. And I hope with this administration, and I wouldn't be surprised if this information I just shared with you all of a sudden starts showing up on TV and state media with look what we just discovered and found, and look how great we are. So it just frustrates me. Last thing I want to cover with, I'm going to have Mike give an update on our stock income portfolio, which answers the question, how do we create income from a portfolio?
Thanks, Mitch. Okay, so with the 10-year U.S. Treasury paying a little bit below 1% the entire year of 2020, people are looking for income. And we started this portfolio back in 2019. And let me just explain what the blue lines are briefly. I'm sorry, what the lines are. The blue line is going to be your average portfolio value. So please don't look at that as performance. That is the amount of the nest egg that I'm using to generate the light green line. The light green line is what we produce each month and call income. Obviously, it's a little bit all over the place. If you look to the left, we had a lot of volatility when it came to China trade war. And then right after the China trade war, the reason the China trade war stuff died down is because we were dealing with COVID. And that's that big drop that you see. And so that's that light green line. The red line is what we try to target every month. We try to target 1% a month. So for $1 million, we're trying to generate $10,000 a month or $120,000 a year as an income substitute or income replacement. And Mitch considers this a bond portfolio, a bond type solution rather than stocks. The dark green line is what we have produced since inception. So think of 1.22%. So we're generating $12,200 every month in income per $1 million with the portfolio on average. Now for the year of 2020, that went down to 1.14%, still above our 1% target. But you see when that big dip occurred during the COVID times, we were very cautious with how we were selling the calls. And for 2020, the portfolio ended up being positive 1.61% for the year. Okay, well, 1.61%, that's not much. Well, you're right, it's not much, but the idea of the portfolio is to not necessarily make money with your nest egg. The nest egg is just a vehicle we're using to spin off cash flow. So in the process of generating 1.61% of positive returns for the year, we generated 13.7% cash flow that was taken out, removed from that portfolio to generate these numbers. So the portfolio did really well in my mind in what is your baseline. What if disaster strikes? If disaster strikes, what's it going to look like? Well, we just lived through that disaster and portfolio held up very well. If you look towards the far right side of the portfolio, these last 4 or 5 months, that's more what I would expect going forward, especially as we get some stability on the political front and going forward. So I would expect more of that, whereas the previous part of the chart was more of an anomaly. And Mitch, if you want to add to that, that is our income solution.
Yeah.
And my mother's been doing this for 25 plus years with my father and I keeping an eye on it for her.
Yeah. And again, bonds are going to be dead for a while. So if you have bonds in your portfolio, individual bonds, let them run their course. But this is a differentiating factor that our firm does that most firms cannot do. Mike and Trey, who are our portfolio management team, they spend over half their time just on this one portfolio. There's a lot of moving pieces. There's a lot of science behind this, and well as some art. But they've done a good job, and many of you are in this portfolio who are on the call. Again, to get in this portfolio, it takes $1 million. If you're still working, it's better if it's an IRA, because all of that income, in this case, if you look at $12,200 a month, that's taxable income. If you're retired, it's a paycheck, and if you were getting bond interest, it'd be the same tax rate. So it's not as great of a strategy for people that are still working, because it does add to your taxable income. So that wraps up our meeting. We're free to open this up for any questions that people may have. Again, we appreciate your faith and confidence and patience, and we will be rotating out of energy at some point. I don't know if it's going to be this quarter or next, but we're paying very close attention to it. And thanks again for your business. So Tab, do we have any questions? Your mic's off, Tab.
We don't have any questions as of right now, but if anybody has a question, they can unmute their mic and ask the question, or they can type it up in that top right corner.
Yeah, if you want to unmute everybody, you could do that, Tab, if you'd like.
And Mitch, I can also say that with the Biden administration taking over, we had a portfolio ready to go for a Trump second administration. We had a portfolio ready to go for a Biden administration. And that portfolio, those decisions were based on policies stated by both administrations and what they were doing. Those portfolios have now, the Biden portfolio has now been fully implemented in our stock portfolios. And we've also rebalanced the ETF portfolios as to the weightings that we want going into 21 and beyond.
Okay, I'm going to turn off the record.